Hello and welcome to KBRA's teleconference on our recent rating of the State of Connecticut's Special Tax Obligation Bonds, Transportation Infrastructure Purposes 2018 Series A. I'm Kate Kennedy and I head our Media Relations Group, and I'm joined this afternoon by my colleagues across the Public Finance Group who will be discussing KBRA's view on this credit. Our prepared remarks will last approximately 15 minutes and we will then turn it over to audience questions. To submit a question, please use the webinar platform, or if you're using the dial-in number and not your computer to listen in today, feel free to email any questions to info@kbra.com. I would like to now turn it over to Karen Daly, the head of our Public Finance and Financial Guarantee Groups.
Thanks, Kate. Good afternoon, everyone. My name is Karen Daly, and I manage the Public Finance and Financial Guarantee Groups at KBRA. Today, we are going to discuss our rating and analysis of Connecticut's special tax revenue bonds. The pledge behind these bonds are a menu of taxes, fees, and charges credited to the state's Special Transportation Fund. The rating, which is AA+ stable, is based on KBRA's U.S. Special Tax Revenue Bond rating methodology. While we will go into more detail in a moment, I want to raise 2 points with the analysts who are dialing in. First, the bonds benefit from a coverage covenant, which is a relative rarity for this sector. Second, in contrast to others, we do not automatically apply a rating ceiling in this sector. As we state in our methodology, to the extent that KBRA is satisfied with the legal analysis and it is supported by the credit assessment, KBRA is of the opinion that a rating above the underlying general obligation rating may be achieved. So let's get back to basics. KBRA's credit ratings are intended to reflect both the probability of default and severity of loss in the event of default, with greater emphasis on probability of default at higher rating categories. So thinking about what I just read, the point I'm making here is that an automatic rating ceiling in the special tax sector and for this particular credit makes no sense to us at KBRA. Now let's hear some of the details on this transaction from Kate Hackett.
Good afternoon, everyone. So as Karen said, I'm starting on page 3, the KBRA rating approach. KBRA has assigned a AA+ rating with a stable outlook on the State of Connecticut Special Tax Obligation Bonds 2018 Series A. These are senior lien bonds. KBRA has also assigned a AA+ rating with a stable outlook to the state's outstanding senior and second lien special tax obligation bonds. KBRA's rating of special tax revenue obligations is based on assessment of the following rating determinants: legal framework, nature of special tax revenues, economic base and demographics, revenue analysis, and coverage and bond structure. And I will discuss each of these determinants briefly. KBRA's AA+ stable rating is based on strong coverage of 2.4 times maximum annual debt service from historical revenues, the state's coverage covenant to maintain 2 times debt service coverage from pledge revenues, and a legal framework that provides strong bondholder protection in the form of a fully funded debt service reserve fund and a strong 2 times additional bonds test. It is KBRA's view that the debt service coverage will continue to be strong because pledge revenues after payment of debt service is needed to fund the operations of the State Department of Transportation and the State Department of Motor Vehicles. I want to take a minute to talk about the State's Special Transportation Fund, or STF. There has been a lot of press about the need for additional revenues for the STF in order to continue the state's capital program and to maintain state transportation operations. Both senior and second lien bonds are payable prior to use of pledged revenues for transportation operations of the state, and coverage is strong, so payment of debt service is not impacted by the current funding issues of the STF. Now on to the legal framework, rating determinant 1. KBRA views the legal and statutory framework underlying the issuance of the state's special tax obligations as providing strong bondholder protection. The senior bonds are secured by a first lien on pledged revenues credited to the state's Special Transportation Fund, and I'm going to refer to it as STF from now on. The second lien bonds are secured by pledged revenues on a subordinate basis. Pledged revenues consist of motor vehicle-related taxes, fees, and charges, and other receipts credited to the STF. The major sources of these revenues include motor fuel taxes, oil company taxes, a portion of the state's general retail sales taxes, and motor vehicles receipts. KBRA sees the state coverage covenant as the real strength of this issue. Under both the senior and second lien indentures, the state covenants to provide pledged revenues in each fiscal year in an amount equal to at least 2 times combined debt service on all senior and second lien bonds. Now, these bonds are primarily state excise tax bonds, and like every state excise tax bond, the state legislature can modify pledged revenues. Here, however, under the authorizing statutes and bond documents, the state may modify or substitute pledged revenues only if the 2 times debt service coverage requirement is met and the projected revenues meet or exceed the projected expenses of the STF. There is also a strong additional bonds test. Under both the senior and second lien indenture, additional bonds may be issued if historical pledged revenues paid to the STF is equal to 2 times combined debt service requirements on outstanding and proposed senior and second lien bonds for the current and each succeeding fiscal year. Both the senior and second lien bonds are secured by a debt service reserve fund, which is cash funded in amount equal to combined maximum annual debt service. KBRA assigns the same rating to the senior and second lien bonds. The second lien indenture includes the same state coverage covenants as the senior indenture. Also, the additional bonds test requires coverage of combined senior and second lien debt service. There is a relatively small amount of second lien debt service debt currently outstanding, and this debt matures in 2022. Rating Determinant 2 addresses the nature of the special tax and the breadth and diversity of the tax base. KBRA views the pledged special taxes as providing a diverse, broad-based source of payment for the bonds. The pledged revenues include a number of taxes and fees on transportation activity across the state. In addition, pledged revenues include a portion of the state sales tax, which is levied on a broad retail sales base. Rating Determinant 3 covers the economic base and the demographics. In KBRA's view, the state economy continues to grow, but at a slower pace than the region and the nation. This is reflected in per capita income, gross state product, and employment levels. The state continues to have a fairly diverse economic base. KBRA notes that the defense industry, which comprises about 1/4 of the state's manufacturing employees, is an important component of the state's economy and has demonstrated renewed strength since 2002, and we expect this trend to continue. Next, I will discuss the revenue analysis, which is Rating Determinant 4. KBRA views the pledged revenues as providing a strong source of security for the bonds. Under state statutes, consensus revenue estimates for the Special Transportation Fund, covering the current biennium and the next 3 fiscal years, are published in November, January, and April of the fiscal year. January 2018 consensus revenue estimates were just released yesterday, and they show very minor declines in pledged revenues from the November estimates, pretty much under 1% decline a year in the years 2018 through 2022. The breakdown of pledge revenues for fiscal year 2017 is as follows. Motor fuels tax represents 35% of pledge revenues. Oil companies tax 17%. Motor vehicle receipts 17%. And sales tax 14%. Total pledge revenues have generally shown slow growth over the past decade. From 2007 to 2017, the average annual growth rate for all pledge revenues was 2.5%. This includes changes in tax rates and the addition of the state sales tax allocation. Generally, the rate of growth of pledge revenues has been impacted by increasing use of more fuel-efficient cars, lower fuel prices, and the relatively slow growth in the state economy since 2008. On an overall basis, historical pledge revenues have shown limited sensitivity to economic conditions, with the exception of the oil companies tax, which is sensitive to oil prices. The general retail sales tax allocated to STF starting in fiscal year 2016 is subject to the level of economic activity in the state and budget decisions by the General Assembly. In 2017, these two sources represented about 31% of pledge revenues. The share of sales tax dedicated to the STF is scheduled to increase. KBRA recognizes the passive nature of the pledge revenues and the potential for volatility in certain pledge revenue sources. However, in KBRA's view, these risks are mitigated by the state's coverage covenant to maintain 2 times debt service coverage from pledge revenues in every fiscal year. I'd like to conclude with a discussion of rating determinant 5, which is coverage and bond structure. KBRA views debt service coverage on combined senior bonds and second lien bonds as very strong, based on MAD's coverage from actual 2017 pledge revenues of 2.4 times. Annual debt service coverage is at least 2.3 times through 2022, based on projected pledged revenues and planned future issuance, which KBRA also considers this level to be very strong. Given that KBRA views some sources of pledge revenues as being subject to certain risks, we developed a stress scenario to assess the impact of potential declines in certain pledged revenues on debt service coverage in fiscal year 2018 through 2022. The KBRA stress scenario assumes a decline of 50% in the level of the general retail sales tax allocations to the STF through 2022, and assumes that growth in the oil company tax is flat through 2022. Based on the KBRA stress scenario, projected annual debt service coverage on combined debt service for both senior and second lien bonds declines from 2.6 times in 2018 to 1.9 times in 2022, coverage which KBRA still considers to be strong. So in conclusion, as I've said before, KBRA recognizes the passive nature of the pledge revenues and the potential for volatility in certain revenue sources. However, in KBRA's view, these risks are mitigated by the state's covenant to maintain 2 times debt service coverage. Thank you.
Great, thank you, Kate. As mentioned, if you have any questions, please submit them through the webinar platform, or additionally, feel free to email info@kbra.com. We're going to just take a minute to compile the questions that we received during the call.
Okay, this is Karen Daly. Our first question relates to the headlines around the state's special transportation fund. There's been a stream of headlines about that fund running out of money. Does this impact the security of the special tax obligation bond?
No, it really doesn't, and this is why. The debt services, as I mentioned, the debt service on the bonds, both the senior and the second lien bonds, are payable prior to use of pledge revenue for the transportation operations of the state, and that's how the flow of funds works. Senior bonds have a first lien on pledged revenues. Second lien bonds have a subordinate lien on pledged revenues. And debt service coverage is strong, so payment of debt service is not impacted by the current need of the STF for additional revenues.
Thank you. Second question relates to revenue sources. Is there any possibility of new types of revenues flowing into the Special Transportation Fund?
This has been a hot topic of discussion over the last couple of years. What has been discussed over the last couple of years includes increases in the gasoline tax, which has been the same for a long time, increases in motor vehicle related taxes, and also electronic tolling on the state's highways and byways. The governor will present his next budget to the General Assembly this coming February 7th, and everybody's thinking that presentation on new revenue sources will be a part of that.
Great, thank you. So we've been reading a lot about the state's financial condition, and do you think there's a risk that the state will reduce the amount of sales taxes going into the Special Transportation Fund?
Let me tell you a little bit about the tax itself. Beginning in 2016, a specific portion of the state's general sales tax revenue was allocated as a new pledged revenue source. And that allocation increased to like 0.5% of total state sales tax in 2018. So that's where we are. There were some additional sales tax revenues allocations approved in 2017 as part of the biennium budget legislation. But let me address your question directly. In 2016 and 17, state budget stress did lead to delays and reductions in some allocations of the state resale sales tax to STF. And that would be for fiscal year 16 and in fiscal year 17. So, and the ongoing budget stress in the state's financial operations did raise the possibility for us that sales tax allocations could be reduced in the future. But there's a couple things that provided some comfort on that. One, that the actions taken in fiscal year 16 and 17 did not cause the state to breach their 2x coverage covenant. Also, the sales tax allocation was not impacted, so it was not delayed or reduced in the budget discussions for fiscal year 2018 and 2019. So they didn't touch it there. But what we did to sort of address that risk of future delays or reduction is that's really reflected in our stress test, which I discussed in the presentation, that what we assumed in the stress test was a 50% decline in the level of general resale sales tax allegations to STF over the next couple of years.
Great, thanks. There's a question as you were talking about coming in about the KBRA stress test. Is it possible to see the stress test? We can't throw it up on the board right now, but what I can offer to do is have you dial in or call Kay Kennedy, and then we'll sit with you and take you through what we did exactly. Kate, do you want to say anything else about the stress test right now, in addition to what you just said?
Well, there were two aspects to what we modified in our stress test. One was, this I covered in my presentation, and let me repeat it, that the stress scenario assumes that we assumed a 50%, let me back up a minute. In terms of projected revenues, the state does put forth these consensus revenue estimates, which covers the current year and the current biennium in the next 3 years. So that is the revenue line of the stress test. We assumed a 50% decline in the level of the general retail sales tax allocations through 2022, and that includes the allocation they're currently getting and the allocation they're projected to start getting in 2021. We also made the assumption that the oil companies' tax growth would be flat through 2022. I think it's fairly onerous stress test. And based on the stress scenario, projected annual debt service coverage on combined debt service for senior and second lien bonds declines from 2.6% in 2018 to 1.9 times. I'm sorry, 2.6 times to 1.9 times in 2022.
Great, thanks. So for the person who wrote that, if that's not enough, call Kay Kennedy and she'll arrange a call with myself and the credit team on this.
Great.
All right.
Thank you for joining today's call. As Karen had mentioned, if you have additional questions that were not addressed on the call today, feel free to email us at info@kbra.com or feel free to reach out to any of us directly. Additionally, please visit our website, kbra.com, to view our ratings and research. Actually, another question just came in.
Okay. Well, right under the wire. Time, I like to say timing in life is everything. Do we want to comment on the likelihood of the approval of the constitutional amendment?
Well, I can't give you odds, but I can say that it's been very much, this whole issue has been very much in front of the public over the last couple years. It's part of the a transportation initiative, Let's Go Connecticut, that was started in launched in 2015 by the governor. So, and this need for this constitutional amendment was identified sort of at the launching of this transportation initiative. So it's been in front of, and it's been in front of the public for several years, and so it's very high profile. So I'll leave you to set your own odds.
Great. All right, well, thank you again for joining. We appreciate it. My direct line is 646-731-2348 if you have any additional questions for our team. Thanks again, and have a good day.